Hello everyone, welcome to my channel where I talk about personal finance. Today I'm going to talk about should you pay off your mortgage early or invest. Before I get into the video, be sure to subscribe and leave a comment below saying I subscribe. I will try to personally reply to your comments. Let's get into the video. It might be difficult to choose between paying off debt and investing for the future. Many families must choose between paying off their mortgage, the largest debt they will likely ever have, and investing for retirement. Both are admirable objectives, but which should be prioritized? Paying down your mortgage first. Let's imagine you are nearing the end of your mortgage, which you took out years ago. Everything been a long road, and you are tempted to pay it off in one lump sum and be debt free, or at the very least, speed up your payments to get it done sooner. While it may sound appealing to pay off your mortgage near the end, it is actually preferable to do so at the start. Although you make the same monthly payment, assuming you have a 30-year fixed rate mortgage, the majority of your money goes towards interest in the early years and does little to lower the loan principal. As a result, making extra payments early on and therefore reducing the principal on which interest is charged could save you a lot of money throughout the life of the loan. Because the same compound interest concepts that apply to your assets also apply to your loans. Paying down more of your principal early will compound your savings over time. In the following years, though your payments will go more towards the loan principal, paying more won't reduce your total interest burden as soon. It will simply increase your home equity and shorten the loan term overall. That's not to say that's a bad thing. However, we are looking for the finest ways to put your money to work. Make a monthly payment calculation. Your monthly mortgage payment is determined by the following factors: home price, down payment, loan length, property taxes, homeowners insurance, and loan interest rate, which is highly dependent on your credit score. So let's pretend your mortgage is still in its early stages. Say inside the first decade, let's say you have a $200,000 30-year fixed loan with a 4.38% interest rate. If you pay 12 times a year, you will pay $159,485 in interest over the life of the loan. If you make a total of 13 payments per year, you will save $27,216 in interest. If you put in an extra $200 per month, you would save $6,000 in 10 years, $50,745 in 22 years, and your mortgage would be paid off as well. It isn't the worst idea in the world to save money on interest. Mortgage interest, on the other hand, is not the same as interest on other types of debt. If you itemize deductions on your tax return, it's tax deductible. You can deduct home mortgage interest on the first 750,000, which is 375,000 if married filing separately, of a loan secured by your home in 2020. You can deduct home mortgage interest on the first 1 million of debt or 500,000 if you married filing separately, if it was incurred before December 16, 2017. The mortgage may be worth retaining if you need to lower the amount you owe Uncle Sam. The 2017 Tax Cuts and Jobs Act (TCJA) almost quadrupled the amount of basic deductions available. Many taxpayers no longer have to itemize their deductions, and many homeowners have stopped taking advantage of the mortgage interest tax deduction. If you have an adjustable rate or other non-standard mortgage, paying it down can be advantageous. If it is later in the game when you are paying off a larger share of the amount. Building equity in a property with an adjustable rate loan will make refinancing to a fixed rate mortgage easier if you ever decide to do so. Paying down a mortgage is also a technique to avoid falling underwater if local real estate values are plummeting and residents in your region are seeing little or no appreciation or even depreciation in their homes. Owning more than your home is worth. It may be difficult for you to sell the home, refinance it, or either other financing as a result of this. Unfortunately, while it is better to pay off or reduce a mortgage sooner, it is also better to begin saving for retirement sooner. Compound interest means that a dollar invested now is worth more than a dollar invested 5 or 10 years from now. That is because it will be earning interest for a longer period of time, and the interest will be earning interest. As a result, every year you put off investing for retirement will cost you a disproportionate amount of money. As a result, saving for retirement at a younger age often makes more sense than paying off a mortgage sooner. Investments of all do not just rise, they also collapse, and their performance can swing widely with the financial markets. Unfortunately, the rewards ain't always as predictable as mortgage payments, but that's all the more reasons to get started investing as soon as possible. Your portfolio has more time to recover from the market's roller coaster behavior. In addition, the stock market has generally grown over time. Assume you had a 150,000 30-year mortgage with a 4.5% fixed interest rate. If you must simply the minimum payments of 760 each month, you will pay 123,609 in interest over the life of the loan. You will pay off the mortgage in 20 years if you pay $948 a month, 188 more, and you will save $46,000 in interest. Let's pretend you instead invest the additional $188 every month and earn a 7% yearly return. On the funds you donated, you would have made 51,000 in 20 years, 5,000 more than the amount you save in interest. If you keep depositing 188 every month for another 10 years, you will end up with 153,420 in earnings. So while it may not seem like a big deal in the short term, saving in your retirement account will almost certainly pay off in the long run. There is a middle ground between these two options. Contribute to your retirement funds while making little additional payments towards your mortgage. This is particularly appealing choice in the early stages of a mortgage when tiny contributions can minimize the amount of interest you will pay in the long run. Alternatively, if the market is still particularly volatile or spiraling downwards, it may be more prudent to pay down your mortgage rather than risk losing investing assets. There is no one size fits all solution to whether it is preferable to pay off a mortgage or invest for retirement because everyone's circumstances are different. You must run your own numbers in each scenario. Overall, do not neglect your retirement plans, long term saving goals by focusing too much on your mortgage. By putting your retirement saving goals first, you will be able to determine whether any additional funds should be put towards your mortgage or your investments. In reality, you should weigh the return prospects of non retirement savings options when paying down a mortgage. For example, if your mortgage interest rate is far more than what you can reasonably expect to earn, it may be profitable to pay it off, and vice versa if you are paying a low rate of interest. Also, if your mortgage has an abnormal high interest rate, it makes financial sense to pay it off first or consider refinancing. Thanks for watching this video and do not forget to subscribe to my channel.